In this video, we're going to be taking a look at some quantitative analytical methods of stock price change. And in particular, we're going to be trying to decide whether or not the stock price change can be described as a normally distributed phenomenon. Next, we're going to be trying to decide if there's a directional bias in this daily change. That is it biased to be positive or negative? And then finally, we're going to be trying to see if the price movement can be described as a random walk. I'm going to be using a Jupyter notebook here, and I'm going to make the notebook available from a link in the video description so you can download it. All right, and with all that, we can go ahead and get started. First thing we're going to want to do is set up our environment, and I'm going to be using typical data analysis libraries in Python. All right, so NumPy, pandas. All right, we're going to be downloading live data using a Yahoo API. All right, and I'm going to access that through this helper library, pandas-datareader. All right, and then to visualize some of these things, I'm going to use matplotlib, and I've just set a few parameters to sort of standardize the output throughout my notebook. All right, so I'm going to go ahead and get the data then. So I'm going to get data for Amazon, and I'm going to use that pandas data reader. Okay, so all we really need is the ticker, but we can set the start and end dates if we like. I'm just going to leave it as the default, which should give us 5 years of price data. Okay, so once we get our data, why don't we just go ahead and take a look at the first few rows to see what we have. And yeah, we have about 5 years worth of data, right? And the high, low, open, close, volume, and then this column adjusted close going back 5 years. All right, so our only consideration here really is I'm just going to be working with the closing price. Should we use close or adjusted close column? And the adjusted close column is helpful when the stock has split. And when a stock has split, you will noticeably see a difference between those two columns. Right, the last time Amazon split was in 1999, so we can see that, okay, there is no difference. It won't really matter which column we use here. All right, but I'm going to use close. For a stock that has recently split, you might consider using adjusted close so you don't get these abnormal jumps in the close to close price on the day that it splits. Next thing we're going to do is go ahead and just store that closing column in its own variable so I can leave the original data unchanged. Okay, once I do that, I'm going to calculate the instantaneous rate of return. Okay, I'm going to do that by using the log of the difference close to close. Okay, and then we'll just take a quick look at what we end up with. Okay, so a couple of things to note here, right? We are calculating the rate of return from the 6th to the 7th, so we lost just a little bit. So if I look at the price there, yeah, we did lose just a little bit, $3 about from the 6th to the 7th. All right, we have this first value is not a number, and that's because it can't be calculated for the first row. All right, and then the third thing is, wow, the output looks kind of ugly. It's because when I get a single column out of a pandas data frame, it turns it into a series. Okay, so if you absolutely must see a pandas data frame, you can just wrap that calculation with pandas.dataframe. All right, I'm not going to bother with that. All right, I'm perfectly happy working with this series. And then, later I may find out that, oh, I need a data frame. But for now, I'm perfectly happy working with the series. All right, let's take a quick look at what this looks like if I plot it. So I'm going to take Amazon return, and I'm just going to hang .plot off the end here. All right, and this is going to go ahead and access the matplotlib plotting function. All right, so pandas has a wrapper or is a wrapper around matplotlib, and that allows us to just have as a method of a pandas series or data frame access to plot. Okay, so we can see that the daily price change jumps around a lot, as we might expect. Now we can see that it basically clusters in around 0 here, and then we have some really large events that happen periodically, all right, and it looks like unpredictably throughout this 5-year period. All right, if you just want to see some of the data so it's a little bit easier to read, we could ask for just, say, the last year's worth of data. All right, so I'm just going to hang some square brackets off the end, go back 1 year, and plot that. Okay, so still pretty noisy, all right, but a little less density on the data points, all right, but tells the same story. Lots of unpredictable variation in the way price moves. All right, we can also get some descriptive statistics for the price movement, all right, and that's pretty straightforward. I take my variable and I hang describe off the end, and we get a pretty little table of basic descriptive statistics. All right, some of the most commonly used measures for describing a distribution. Okay, there's lots of ways to get descriptives out. We can get them individually. We can use other tools. All right, so I'm going to import stats from SciPy. Okay, and then I am going to use describe in scipy.stats. Okay, so we get a slightly less well-formatted output. We get some different descriptives here. All right, and then just notice here that, oh, they all say not a number, not a number. And the difference between accessing, say, something in NumPy or SciPy and doing calculations on it is that neither of those tools handles not a number values very well. All right, so you can see that this has 1,258 observations, and this one has 1257. It's because of that first row where we couldn't calculate the return. Okay, so I'm just going to make one quick change, and I'm going to get rid of that missing value. So I'm going to hang off the end of the variable drop NA. All right, and if I just run it like this, we get a view, so we don't actually change the data. To change the data, I'm going to ask it to do it in place. Okay, no real change here. And then when I run the describe on scipy.stats, all right, I get values again. Okay, and so most of the same stuff is there, right? Min, max, mean, those kinds of things. All right, a couple of new things that we get here are skewness and kurtosis. So from this, we can sort of make some basic judgments about whether the distribution can be described as normal. All right, skewness is slightly positive. All right, 0 would indicate no skewness, all right, and a negative number would be skewed towards the left. This one is slightly skewed towards the right. It's probably not enough to be meaningful. All right, kurtosis tells a different story, and this is actually a Fisher kurtosis, which means it's been normalized. All right, so a normal distribution has a kurtosis of 3, all right, and the Fisher kurtosis subtracts 3 from the calculation. All right, so the raw kurtosis here is 7.4, and normalized, we're basically saying, oh, this has 4.4 excess kurtosis. So it sure looks like the distribution is more peaked, much more peaked than we would expect from a normal. All right, so this means that we have way more observations in towards the center than you would expect in a normally distributed population. And it also tends to mean that there are fatter tails. All right, so most of the time, basically what this means is that, okay, we have a lot of boring days, and then once in a while, more often than you might expect, we have these big days. Okay, I'm going to make one more change before we move on. All right, so some of these numbers are very small. I'm going to turn them into percentages. I'm just going to go back and multiply everything by 100 so that we're dealing with numbers that are a little bit more meaningful or easy to interpret anyway. Okay, so way up here, what I'm going to do is clean up the numbers a little bit. Okay, so I basically remove a couple of decimals. It makes the numbers a little bit easier to read. All right, it makes no other change. All right, if I run the rest of our analysis, right, again, we just get something that's a little bit easier to read. I remove 2 decimals or 2 zeros to the left. Okay, I'm going to unpack our descriptives from scipy.stats into variables. Okay, and this is just going to allow me to access them other places by just referring to them. All right, and then the min-max was a tuple, so I'll unpack that. And the variance I want to convert into a standard deviation. Okay, so before I actually run a statistical test on this, I want to get a visual comparison of the daily price change. I'm going to compare it to a sample of the same size that I draw from a normal distribution, just so we can see what it looks like. All right, so the first thing I'll just do is go ahead and plot as a histogram that Amazon return. And I'll just add a number of bins. It's a little bit bigger than the standard. Okay, so we get our graph, and you notice there's a lot of sort of output here that's not really relevant. It's telling where the bin edges are and the counts and things like that. All right, so I'm going to suppress that using a semicolon. All right, and so we're left with this graph, and as expected, right, we have a lot of activity going on here in the middle. All right, and then, right, the returns actually spread out to the left and right, far beyond what you might expect to see in a normal distribution. All right, so most of the data in a normal is probably going to fall within plus or minus 4, and we can see we have, some pretty big moves, and they're not just one-offs, right? These things plus or minus 5 over here are pretty frequent. All right, so those are those fatter tails I was talking about. All right, let's compare it and draw a sample of 1,257 observations from a normal distribution. All right, to do that, I'm going to import the normal module from scipy.stats. Okay, and then I'm going to just call my variable x, and I'm going to do norm random variate, and I'm going to use the mean of the Amazon price change. I'm going to use the standard deviation of the Amazon price change, and I'm going to use the n. Okay, and then once we do that, we will plot it as a histogram, and it'll sort of be stacked here so we can see it. Okay, so if I draw a random sample of 1,200 from a normal distribution, we can see a much different story. All right, the data is sort of a little bit squatter. It's spread out a little bit more uniformly here. And yeah, we had a couple that were out beyond, plus or minus 4. All right, but certainly not as representative as we had up above or as much spread. Okay, next I'm going to go ahead and run a statistical test on this data, and I'm going to run it on both the normal variable that I just generated and the Amazon returns. All right, so down here, right, the test I'm using is from SciPy.stats. It's a Kurtosis test, and the Kurtosis test is testing whether or not we can consider the distribution normal. All right, the null hypothesis is that it must be coming from a normal distribution, and if we have enough evidence, we're going to reject that null. All right, so I'm doing this side by side here, and the rest of this is some formatting of the output, so I get a pretty decent table formatted in output. All right, so I'm just going to run this cell, and we get our test statistic and p-value. All right, so for the data selected from a normally distributed variable, right, my test statistic negative 1.53. All right, and we can't get a lot from that. All right, certainly if we remember our statistics. If we're doing a hypothesis test, most of the time we need a test statistic in excess of -2 or +2 to start rejecting. All right, but we don't know exactly where the critical value is here. All right, so much easier to interpret that p-value, which you get from the Kurtosis test. And at 0.12, essentially we're saying if we reject the null, all right, there's around a 12% chance that we're making a mistake by doing that. Okay, so another way to interpret this is most hypothesis tests coming in would have a alpha of 0.05, and we'd be able to reject the null when the p-value was less than 0.05, and we shouldn't reject it if it's greater than 0.05. All right, another interpretation of this is, well, there's about a 12 or 13% chance that we got the variation we see in that x variable from random chance. All right. Amazon tells a different story. Our test statistic much larger, all right, way past the 2 or -2. All right, the p-value isn't really 0, all right, so somehow the limit or the precision of this test starts saying it's 0 when it gets far enough out there. It's very, very small. It's not 0, all right? So in other words, what we're saying here is that we really should reject the null and conclude that the price change of Amazon cannot be described as normally distributed. All right, and you can run this on other stocks to see how well they measure up. We're going to take another look at this visually here and see if I can drop a normal curve over the histogram. All right, so make a couple of changes from the initial histogram. Right, these are telling our frequencies here. I want the proportions, and so then I can overlay a theoretical normal over that, and we can just see how far outside the theoretical normal it is. All right, so I'm going to start by using matplotlib and histogram, Amazon returns. I'm going to get a few more bins in there. I'm going to set an edge color. All right, and to get the proportions, I'm going to set my density true. Okay, so that's how it starts to look there. Okay, I'm going to set up my overlay, and I'm going to use NumPy's line space to get my limits and equally spaced data points. I'm going to use the minimum and the maximum of the Amazon returns, and I'm going to make an array of 100 equally spaced data points in that array between the min and the max, and then I'm just going to go ahead and plot that. All right, and I'm going to be using the normal probability density function to do this. All right, so there it is with a theoretical normal that would have the parameters of the Amazon price change. All right, and you can see that, yeah, the middle is way overrepresented here. All right, so these bars greatly exceeding the theoretical. All right, and then out at the edges here, you can see that a little bit here that things that are very large in either direction seem to be overly represented. Okay, so kind of a lot of work here to get towards this answer to our first question. Can the price change of Amazon be described as normally distributed? And I guess we're saying no, it cannot. Okay, so we're going to move on to our second question. And this is, can the price change be described as significantly different from zero? All right, so is there a bias for this thing to, on average, increase or on average decrease? And this is much simpler, right? We've done most of the work that we need in the setup of this. And so all I'm going to do is use scipy.stats here, and I'm going to run a t-test. All right, and it's going to be on a single sample, and it's going to be Amazon returns. And the hypothesis we're testing is, or the null is, that the return is 0. All right, so this is a two-tailed test. If it's significantly smaller than 0 or larger than 0, then we're going to say that, yes, there is some directional bias here. All right, and then we need to set our alternative. All right, and this is just, is it one-tailed or two-tailed? This one is two-sided because we don't have any reason to believe coming in that this bias, if it exists, is negative or positive. All right, so we want to test, is it different from 0? All right, so I'm going to go ahead and run that. Okay, so going back to what we were talking about in the kurtosis test, right, we said, okay, that the statistic is a little bit hard to interpret, right? This is greater than 2, all right, but still we don't exactly know where that critical value is. All right, p-value still easier to interpret, and if alpha coming in was 0.05 and I got a p-value of less than that, we're saying we can reject the null that the price change does not have any directional bias. All right, the only problem with this is the sample is so large that I could pretty much prove anything. All right, so with a really large sample, any small variation away from whatever the null hypothesized mean is probably going to look significant. All right, so in this case, the sample's too large. In the kurtosis test, it actually works better if you have a large sample, and it kind of works in the opposite direction if we're just testing something like a simple comparison of the mean of the sample versus the population. All right, so what I'm going to do is sample about 20% of the data. All right, and I'm going to just hang off this sample method on the series, and I will get a year's worth of data and rerun our test. And when I rerun our test on just a year's worth of data randomly chosen from our 1257 observations, we get a much different test statistic, all right, of just over 1 standard deviation away from that mean of 0. All right, and then we get a p-value of, about 0.22. Essentially saying that, okay, we're probably seeing the variation here by random chance, or there's a 22% chance that if I reject the null, that I'll be making a mistake when I do that. Okay, the last thing we're going to be taking a look at is, can the price movement be described as a random walk? All right, this is one of the main theories in finance, or the finance of stock price movement anyway. And there's lots of ways to sort of look at this thing. Essentially what we're going to be saying is that, well, if the price is a random walk, right, then it's going to be hard to predict. And the best predictor, or at least a good predictor, if I have a randomly moving system, is going to be to forecast tomorrow's price with today's. All right, so lots of different ways to do that. All I would have to do is sort of lag the price by one and then plot one against the other to see how well that model fits. All right, but I'm going to get a chance here to show you a simple linear regression model, so I'm going to do that instead. It's going to work out about the same, all right, but it's just going to look a little unnecessarily complex, all right, but you will be able to see NumPy's linear regression model, one of them anyway. All right, so here what I'm going to do is take the Amazon close, and I am going to turn it into a data frame so I can add some columns to it. Okay, and I'm going to add two columns here. I'm just going to offset the close by 1 and 2 days. Okay, so there I offset it by 1. Just copy all this and do it again. Okay, then we'll take a quick look at the top of this thing. Okay, so there it is, offset by 1 and 2 days, right? So there is that price. All right, and there it is there, offset by 1. All right, so essentially what we're saying here is that we're going to be able to predict this 726.64 with both of these data points. To do this in NumPy, again, we mentioned already that it does not handle these not numbers very well. So I am going to just drop them off. Okay, so there it is. All right, and then with that, we are ready to go ahead and use our linear regression model in NumPy. All right, so first we'll display the output, and then I'll store it as a model. All right, so I'm going to use the linear algebra module and then the least squares model. And I'm going to tell it what the independent variables are. So from that Amazon close, all right, it's the lag1 column and lag2. And I'm going to be using them to predict the close. All right, and we actually get quite a bit of output here. All right, I'm going to fix that warning in just a second. It's basically telling me that I did not set this threshold level here to basically zero out small values. All right, so in some models, this rcond parameter is set so that when values get sufficiently below some threshold or above some threshold, you just set them to 0. All right, I'm going to ignore that. All right, but I do have to suppress it. And then I just want you to see that you get a couple of things here. All right, a couple of values, all right, that are calculating errors and slopes of our 2 lag columns. All right, let me just hide some of this. I'm going to rcond in here and tell it to be none. Okay, and so there's our slope coefficients for lag1 and lag2. And from this, basically, we're saying that, oh, okay, 94-ish% of tomorrow's price can be predicted by today's. All right, and then the rest of it can be predicted with that second lag. All right, it's not going to be exact, but essentially that's what the model is saying. And then what we're going to do here with our model in hand is we're going to go fit it to the actual data, and then we'll plot it and see how closely it follows the actual price. Okay, so I'm going to add another column here. All right, we'll call it predict. All right, so I'm going to matrix multiply the lags here by the output of the regression model. Okay, and we're going to end up with, for each day, a prediction of that price. Okay, and then we'll just take a quick look. Okay, so there is our prediction All right, there's our next prediction. And we can see that, okay, sometimes it's very close and sometimes it's not as close. All right, let's visualize this to see just how far off our model is. Okay, and we can see that when I plot this, they're virtually indistinguishable. All right, you can just see a little bit of blue peeking out from under there. All right, and if we want, we can just again look at probably the last year's worth of data to see how well today's price is at forecasting tomorrow's. Okay, so a little bit easier to see here where the errors are, all right, but we can see that, well, they're small, all right, so in fact, we can forecast tomorrow's price pretty well with today's price. All right, so a lot of information here. I hope that's going to help you get started quantitatively analyzing the stock price movement.